The meeting of the City of Santa Barbara, the City Council's Finance Committee for December 18th, 2012 will now come to order. Any members of the public wishing to speak on items not on the agenda? Seeing none, we will go to our first and last agenda item.
Yes.
Mr. Samario.
Thank you, Mr. Chair, members of the committee. Bob Samario, Finance Director. And we're going to spend about 30 to 40 minutes today talking about our comprehensive annual financial report, we call the CAFR. And this is for the year ended June 30, 2012. And what I'm going to cover today, and actually I'm going to, one piece, the last piece will be covered by Mr. Rich Kikuchi, who from our audit firm. He'll cover the audit requirements and results, but I'll be covering some background information, how to read the report, sort of its layout and format, because it is a big document, as you can see in front of you. Some financial highlights. These are really high-level highlights. And then, as I said, we'll get into the audit requirements and results. So forgive me for, I know some of the basic stuff, but just to kind of answer the question, what is a CAFR? It's important to note that it is something we only do once a year. You know, as you know, we come to council every quarter. We provide on a consent calendar basis monthly reports on how we're doing revenue and expenditure-wise. But this is an annual report that we prepare. It's a pretty lengthy process, a big report, and it's something that really virtually every company or every government organization produces on an annual basis. What's important to note about it is it's standardized. It's not something that we produce that, you know, in our own fashion. If you were to look at any city across the country and look at their comprehensive annual financial report, it'll look exactly the same sections, different numbers, different words, but you can find the same things in the same places. And it's prepared, and this is an important point, in accordance with what's called GAAP, or generally accepted accounting principles. That means, you know, across the country, you're not going to see a different kind of reporting treatment on different transactions. It will all be consistent from entity to entity. Its purpose is to present to you and to the community the results of our operations and our financial condition. That's the whole point. How healthy are we, and how is that changing over time, particularly in the last year. We call it a comprehensive annual report because there are certain sections in this document, particularly the last section, which we call the statistical section, that isn't required for accounting standards. And we do that for two reasons primarily. One is because it allows us to submit the document for what's called the GFOA award program. It's a recognition program for excellence in financial reporting, and we like to sort of submit for that because I think it's important. You know, it's just a higher level of standard that we impose on ourselves. But we believe it also provides more information to the readers about the city's finances. So it's prepared because it's required by our city charter. We are required under the city charter to prepare an annual financial report that is audited by an external or independent certified public accountant, or CPA. It's also required by state law. And it's important also in issuing or selling bonds. Credit agencies, you know, when they evaluate what kind of credit we are, therefore what kind of interest rate we might have to pay on debt, they look at our CAFR. They actually read this very carefully. They know what it says. They're very familiar with this document. And they use that as a basis to evaluate how healthy we are and our ability to repay any bonds we might issue. And then we also prepared because we think it conveys important information about the city's finances. You know, the budget sort of looks forward. This looks backward about how we actually did relative to the budget, but just in general. So the layout and format, I'm going to have you periodically refer to certain pages as we kind of go through this. So if you can go to the table of contents, and I'll turn to that page as well. It's page I. One of the first pages in the document. So what you're going to see as you look through the table of contents is that there are three main sections to this document. This section we call the introductory section. And this section includes a letter of transmittal, and it also provides some information about the city's organization, like the list of city officials. It has an organization chart. And this portion of the document is not covered by the audit report. So when the auditors come out and issue an opinion about our financial statements, they don't evaluate this. This is just kind of our information about the city, and it's just additional information that we like to include. The main body of the document is the financial section, and this is, as I said, is covered by the audit opinion. It includes a two-page report from Lansall and Lunghart, our auditors, again, the partner being Rich Kikuchi, and this is where they tell us how we did. in a real brief version. We also have a document or a section called the Management's Discussion and Analysis, which I think is really important because, as you can tell, there's a lot of numbers in this document, hard to really understand what it all means. And the Management's Discussion and Analysis, which we call the MD&A, is sort of the budget message of the budget document. If you want to sort of read one thing in the document, that's the place to look. It highlights, how we had ended the year, some major transactions, major items that came up, so an important part of it. And then there's what we call the basic financial statements. This is sort of the core of the whole document. This, if you were to lift this portion out, you would be able to discern how we did this past year. And then the footnotes to the financial statements, that's also very important. It provides a lot more detail about the numbers. And then the part that I sort of mentioned before, the statistical section, this is the part that also unaudited, but this is the part that makes this a comprehensive annual financial report. We don't need to have this section, but we put it in anyway. And it provides a lot of good information, and it also goes back 10 years on a lot of the data. So we're going to focus our presentation, or I'm going to focus the presentation today on two parts, the independent auditor's report, which Rich will cover later, and then the basic financial statements. So within the basic financial statements, it's organized into two sections. And I think this is really important because when you look at this, it's easy to get confused. But there are, in the first few pages, and I'm going to have you turn to page 24. You'll see that there are two pages opposing each other. This is what we call the government-wide statements, and it was newly required back in 2001 for a lot of reasons. But this represents a consolidation of the entire city, all its funds and operations, into two categories, what they call the governmental activities and business-type activities. It was required back in 2001 because there was a lot of, criticism. There's perceived criticism about government because generally speaking, when you look at the old version of financial statements, you really couldn't assess the financial condition of an organization in the old way of reporting. So because we report things on an accrual basis, and these statements include all the city assets, and long-term assets, short-term assets, and all debt, it really does allow the reader to assess the financial condition of our city as a whole. It's a little hard to do so, in my opinion, because it consolidates a lot of things so that distinct operations into one column. For example, all of our enterprise funds are in one column. But the theory is that this helps the reader, should help the reader see, are we in good financial condition, and is that kind of financial condition getting worse or better over time, at least over the last year. And then we also have what's called behind this, the rest of it sort of in the several pages beyond that is what we have, the old way of reporting the individual fund financial statements. So we think of the general fund. You'll see that the general fund is shown by itself as a separate column. And this is the format we've had for many, many years. It's reported differently. We're not on an accrual basis necessarily. It's what's called a modified accrual basis, and we'll talk about what that means. But essentially means that only short-term assets and liabilities are included on the balance sheet. But the purpose of this report versus the government-wide is not to assess the financial condition. You can't assess the financial condition on these individual financial statements. It's really to determine what kind of spendable resources we have available on any given point in time, like reserves. We talk about reserves. How much reserves do we have? We don't care how much we have in terms of equipment and buildings from a budgetary perspective because you can't spend those things. This is really liquid assets that we're kind of referring to here or focusing on. So financial highlights, I can't really give a report without mentioning the fact that this document reflects some significant changes because of the elimination of the RDA or the dissolution of the RDA on January 31st. So what you're going to find if you were to go through the financial report is that there are several changes that are reflected. One is the fact that we had to reverse the transfer of assets and liabilities from the RDA to the city that were made in June of 2011. So last year, for the fiscal year ended June 30, 2011, right in that June, you might recall that we came to council and asked them to transfer all the assets of the former RDA to the city. That was in anticipation that we were expecting the state law that would potentially dissolve the RDAs. So as a way to sort of protect us from any action, we transferred all those assets from the RDA to the city. Well, with the law that came into place, it became became clear to us that we shouldn't have done that, or we at least need to reverse that. So what you're going to see is a reversal of all that we did in June of 11 in this current year. And then on January 31st, when the RDAs effectively did go away, we didn't have to, at that point, transfer things back out. So we sort of said, well, we did in 2011, but we shouldn't have, so we reversed that. But then we made it occur on January 31st, 2012, when the RDA really became, when it really became dissolved or eliminated. So again, big changes in the financial statements. And what we've done is we've transferred all those assets as of February 1st, effectively, to a new fund called the Successor Agency Private Purpose Trust Fund. So we have this new entity, in a sense, the Successor Agency, that now accounts for all those assets and liabilities of the former RDA. And the only exclusion of that is the housing portion, which has now been transferred to the city. But everything else that used to be part of the RDA is accounted for in the Successor Agency Fund, which is a private purpose trust fund. So on page 24 is, again, the statement of net assets, government-wide statements. I wanted just to kind of walk through with you on this, a little bit of some of the highlights. The first thing I wanted to indicate here, if you look on the screen, is that in red I boxed in what are called the business type activities. And it's easier to talk about this versus the other column, because this is essentially all of our enterprise funds consolidated into one column. So our water fund, wastewater fund, downtown parking, airport, waterfront, our solid waste fund, all of those activities are now consolidated into one column. You can decide for yourself whether there's value in that or not, but that's now a requirement that we do that. Next to that is everything else, all what are called governmental activities. The primary activity being the general fund, of course, is the biggest fund we have in the city. That's in this column, but it includes things like our Creeks funds, things that are always called special revenue funds. Creeks Fund, Measure A Fund, our CDBG fund, streets funds. All of those are activities are now reflected in this one column. One of the things I think is important to note, as I said before, is that this includes and reports all of the capital assets. And we've always done that with our enterprise funds. You've always seen in their balance sheets in the past that, you know, all the water mains or sewer mains or whatever those assets may be. But you typically wouldn't be having that conversation when you're talking about the general fund. But this, in the governmental activities column, for example, you see all the capital assets. And you can see that it actually pretty close to what we have in the enterprise funds. You always think of enterprise funds as being capital intensive, but there are a lot of capital assets in our governmental activities. We have $306 million of assets within that column. So it's streets, sidewalks, it's buildings, it's land, all the things that are part of the governmental operations. So we have quite a few assets, and this is based on historical cost. So it's not market value, it's all historical cost. And then what you also see is all the non-current liabilities or long-term debt. Always have seen that in the business type activities column for water fund, any revenue bonds you might have. But you typically don't see in the governmental activities. When we talk about the general fund, it's long-term debt. And there's about $21 million of debt within the governmental activities. Part of that is not sort of bonds, but it's things like accrued leave. It's things like claims that are payable, so things that are not related to long-term debt per se, but still apply to our governmental activities. In the business type activities column, that's primarily bonds. The water, the wastewater have a lot of revenue bonds. As you know, they also have a lot of state revolving loan debt in those funds. And then this bottom section is supposed to tell you the true financial position of the consolidated entity. So the net assets, it's always been a measure of financial condition because it really represents nothing more than the difference between our assets, things we own, and what we owe against that. And the net of that, it's like equity or your own sort of how think about your house. If you have a house that's worth $500,000, but you owe $300,000, then you have equity of $200,000. That's a good thing. If it were the opposite, like some people are, it's a negative thing. And so we have positive balances, of course, no surprise, but this is supposed to tell you that, okay, what kind of financial condition we are, but it's really a snapshot. you can only really evaluate this in comparison to prior years, right? What's the trend? Are we getting better or are we getting worse over time? Are these numbers shrinking or are they growing? And I will tell you, generally speaking, they are growing, and they tend to grow from year to year. Individual funds may have some down years, but on an overall basis, our financial condition for the city as a whole is getting better over time. So still with the government-wide statements, this is the sort of the statement of activities. This tells you, okay, how did we do for the year? Were we better off or worse off, and how did that change? And if you look on page 25, this is just the section that you can see for the top section relating to governmental activities. So this is sort of the revenues and expenses of governmental activities. Doesn't include the business type activities at this point. And the way it's organized is on the far left, you'll see the main functions of those governmental activities. And it's not just the general fund, because, again, it's beyond that. But it's organized into 7 categories: administration, public safety, public works, community services. That would include library, parks and recreation, and the like. Then there's community development, and then interest and long-term debt. And the whole point of this is to show, if you look at their direct expenses and their direct revenues, so we think about fees and charges that relate to those functions, to what extent are they covering those costs from those fees and charges? And for example, administration, as you would expect, they don't charge fees to customers, that they have a high net negative number. They have $11 million in expenses, but only recover $1.3 million through fees or charges. So on a net basis, they require a subsidy of $9.7 million. Public safety, very typical, $57 million in expenses, only generate about $11 million in revenues through charges and fees, and require a subsidy of $46.7 million, and so forth. So you can kind of see where the different levels of subsidy that's required for each function. I will point out that in administration it's a little misleading, because in reality, as you know, administrative departments like finance and city attorney and city administrators, they recover a fair amount of their costs through their overhead. And overhead is not included in the program revenue. It's actually included down below under other, whereas the $9.9 million. So it's a little misleading. So you can see in the far right, the total of those negative numbers, $82.8 million. That's the amount of subsidy required for those operations that come from those items down below that. The largest piece, of course, taxes. Tax revenues are general in nature, and that's what they're used for, primarily public safety, but for other areas where the fees and charges aren't covering those costs. I wanted to point out this number here. This is a transfer that we made, again, going back to 2011. One of the things we transferred from the RDA was we transferred all the parking structures from the RDA to the downtown parking fund. That's where we believe it belonged. And as I said, we had to reverse that. So what you're going to see is that transfer is saying we're going to transfer those assets out from the back from the, maybe I misspoke on that. This transfer of $27.8 million relates to the RDA. I misspoke. I'm not sure if it's the parking structures directly, but it's reversing transfers that were made last in 2011 that we're having to undo now. But you'll see the big number really being this extraordinary loss. This is where we're now transferring all of the RDA assets and liabilities from the RDA as of January 31st to the successor agency, the separate trust fund. And so we're really transferring a net of $91.2 million of assets from the former RDA into the separate fund that's accounted for outside of these statements. If we were to sort of adjust for that, we would really be seeing our net assets at the end of the year go up rather than go down by $48 million. Again, just that transfer of RDA makes it look like we're sort of losing our financial condition substantially, but in reality we're not. We're actually increasing, but it's just that we had to transfer so many assets from the RDA out to the separate fund for the successor agency. Any questions on this? I know it's kind of complicated.
Questions? I have a question. Mr. Samario, back on page 24, near the bottom there are 2 categories: net pension obligation and other post-employment benefits.
Yes.
Could you explain what those are? I'm on page 24 near the bottom, just above the net assets in bold.
Right. So within both categories, you'll see under non-current liabilities, the details of that include what's called, and we're going to talk about this a little bit in one of the footnote disclosures, but in addition to our retirement benefits that we provide other benefits to our retirees, one being a stipend, a monthly stipend up to the age of 65 for medical costs. We call it the retiree medical payment. It's a maximum of about $300 to $350 per month. And again, once they retire, assuming that they're here with the city 15 years, and based on how many years they are with the city, they get the stipend. And that's considered just like a pension, it's considered other post-employment benefit. And we have to disclose what the liability is. And to the extent that we're not funding that liability each year, we have to then record that as a liability within our books. So, as you know, we are on a pay-as-you-go basis currently with those other post-employment benefits, retiree medical, the sick leave, and then what's called the implied subsidy. This is where we allow our retirees to participate in our group insurance plan and therefore get a discounted premium. That's considered sort of a benefit, if you will, when they retire that we have to measure and fund. And so, again, to the extent we're not funding that, we have to book that as a liability. So that's what that number is. That's the governmental activities portion as well as the business type activities portion of the unfunded liability. And, over in this next budget cycle, we're going to try to make progress toward now, not just staying on a pay-as-you-go basis, but making some contributions to start funding some of that unfunded liability. And when we get into that footnote disclosure about this, I'll talk more about that.
Okay.
That's a good question.
Mr. White?
Thank you. I struggle with the capital assets number because it does, if it's what the stated cost is of that asset, there's no real relationship to what it's worth today. Is there any effort along the way to bring that up to what is everything worth today, or is that just like a project by project basis that you might take that on?
Well, I mean, if your question is there an effort for us, for the accounting world, to start moving toward a more market value or replacement cost basis
Again,
for financial
replacement cost would be
reporting?
one element, yeah.
No, and that's unfortunately it's one of the tenets of financial reporting, because market values are subjective. Even replacement costs can be subjective, but there's no way to argue historical cost. It's extremely objective, and as long as every single organization is measuring it that way, at least you see consistency. Through other measures of your budget document or other planning documents, you can sort of disclose and talk about, so what's it really going to cost, however, to replace this infrastructure or this equipment or this building.
Right.
But on this document, unfortunately or fortunately, depending on your perspective, it's always based on historical cost, because it's just the most objective measure.
And then somewhere in here, I saw one of these capital asset numbers that also included depreciation in it. Can you describe that?
Sure.
Not in this. That's not in this one, but it would be in others.
No, it is actually where you see capital assets, and if you look on page 24 as well, you'll see that the more details of what those capital assets include. It also indicates in the description that's net of accumulated depreciation. So that's the depreciated number, what we call the book value. The historical cost may be somewhere around $800 million, but because we depreciate things over time, that number tends to go down. Now, one measure that people who kind of look at these things, they look, okay, is that number is it really going down dramatically, which means you're depreciating it, but you're not replacing it with new? So it should be a fairly stable number over time, because you should be replacing it to the extent you depreciate. And in fact, if you look at like a water fund and what their annual depreciation is, it's pretty close to what they're investing every year in new equipment or new infrastructure or improving infrastructure. So it tends to be a stable number. So what's depreciated is almost about what they spend in replacement or improvements every year. But that's what it should be.
And depreciation is always based on its original cost,
It is.
not on what the replacement value is.
Exactly, because it's nothing more than taking, if you spend $1 million on a piece of
1/20th or
equipment,
1/50th or
you
whatever it
recognize, well, I'm going to be using that over a 20-year period or a 10-year period, so I don't want to incur that cost in 1 year. I want to spread that cost over the time that it's benefiting the organization. So that's called depreciation. You depreciate over the useful life of that asset.
And if that asset is used more than its stated life, it just has a net value of zero. You don't
Right.
keep going after
That's true.
zero.
It just gets to zero, and then that's it.
Okay.
Yeah.
Thank you.
Sure.
Thank you, Mr. Chair.
So let's go through the business type activities, a much different presentation because, as you know, our enterprise fund operations, their fees are designed to recover all their costs. It's not like the general like a general fund, for example, that relies on taxes to subsidize its public safety function or community development function. The fees and charges here in enterprise funds should match their expenses. Every year they're not going to, but they should be pretty much in line on a year-to-year basis. So if you look at the water fund, for example, that's the first row, their expenses were almost $30 million, and they had $36.4 million in revenue, so they actually ended up with surplus. And I'm going to talk more about what that is because that's a big number. But if you can see the other ones, they're pretty close to being sort of end of the year balanced. The wastewater fund ended up a little bit under, meaning they spent $324,000 more than they brought in, which meant they used reserves by a small amount. The airport similarly used some reserves, and some of that was anticipated. The airport had a kind of a tough year last year with the terminal expansion, being sort of delayed. Short-term parking revenues weren't what they thought, all the related concession revenues and all that. But this year they're more on track, so we're going to see that number, of course, be a positive this year, at least hopefully. The waterfront fund had a surplus and so forth. So that's the whole point. And down below, you can see some of the other revenues that go into that are much smaller because you don't see taxes there. We do report investment income as a non-direct revenue, but that is spread out to help sort of offset some of those other negatives. Back to the water fund, $6.3 million. That really is a surplus for a number of reasons. One of the big reasons is that over the last couple of years, in anticipation of getting a state revolving loan, the water fund advanced some costs for certain projects, the Cater project specifically. And this year, they got reimbursed through the state for what they had incurred in prior years of almost $3 million. So that's really why you see a big number this year. They also just had a lot of costs coming under budget. Chemicals and supplies were about $1 million what they anticipated. Salaries and benefits were below. And so overall, they ended up having a really good year, primarily because of that one reimbursement I mentioned, but they added to the reserves of almost $6.4 million. So the transfers here, the $27.8 million, that is a transferring from, again, transferring activities to the successor agency fund, $27.8 million. It shows as a negative number, but it just means we're shifting up sort of where we're reporting things. And you can see down at the bottom, where they were at the beginning of the year, they are now below that. But if you sort of take out the fact that we're just accounting for the successor agency differently, they actually had a positive year this year. Overall, their net assets increased, which means that their financial condition overall went up. Okay, now this is a more familiar format. The general fund, this is their balance sheet, we call it. It shows their assets, liabilities, and fund balances. Again, what I want to point out, unlike in the government-wide statements, you don't see any capital assets here. You don't see any long-term debt. And therefore, the net asset number, or fund balance is what we call, is really not a measure of financial condition. It's just a measure of what kind of liquid assets we have to spend for like next year to appropriate from a budgetary perspective. It shows all the cash and investments, receivables, loans, and so forth. At the end of June 30, 2012, the general fund had $34 million in assets, only $6.5 million in liabilities against those assets. And overall, they had fund balances of $27 million, so the general fund did. And you can see that we are now required to disclose our fund balances into different categories. That's actually started last year. The first is non-spendable, and this really refers to the fact that some of the assets we have here are not available for us to spend in the next year. For example, if you take the loans receivable of $3.9 million, those are the MLAP loans we have with our employees. It's an asset of the general fund. It's a good thing. Unfortunately, we can't spend it next year. We'll eventually be able to spend it as they repay those loans back, the principal and interest, but today we can't spend that. So we separate that and say, well, as part of our fund balance below, we know that it's non-spendable. We also include within that advances to other funds. As you know, we've loaned money to our waterfront fund. We've loaned money to just different to the Gulf Fund. All those are considered advances to other funds that, again, are not spendable today. Theoretically, we can call some of those loans. We could say to the waterfront, who has plenty of reserves, hey, we need the money in an emergency. We can call that. And so when we talk to you about reserves during sort of the budget process or just during the year, and we tell you what our reserve balance is, we don't always include some of that as being non-spendable. We consider that to be available if we need it. So that's why the $18 million below, which the policy reserves, looks a little low. It's in reality is closer to $20 or $21 million because part of these advances we consider to be available. But from an accounting perspective, those two items plus this item is what we consider to be non-spendable. Restricted are for things like purchase orders and contracts at the end of the year. Committed is when council says we want to designate certain portions of our fund balance for a specific purpose. That's our policy reserves, disaster reserves, budgetary reserves, and the like. Any questions on this? This is a little more familiar in terms of format. And this is then sticking with the general fund. This is on page 83. In fact, I would encourage you to turn to page 83 because it gives you a lot more detail than this. On 83, we sort of show all the detailed revenues and expenditures by department, showing the originally adopted budget, what the amended budget was. We have carryovers, as you know, and we have amendments throughout the year, and how that compares to our actual results. And this is just a summarized version that I put on the screen. So in total revenues, we came in under budget. I know that's a surprise, but we budgeted $103.9, almost $104 million. On an actual basis, we fell below that by $350. Now, that's technically not true. The fact is that, as you know, tax revenues came in better than we thought, but we always budget. Remember that whole anticipated year-end variance of $1.2 million we budget every year? That always sort of, we know that's going to be a negative number by the end of the year because we don't realize those revenues. That's supposed to be a measure of expenditure savings. But even with that, we still, even the fact that we had that anticipated year variance number budgeted that's not realized on a revenue basis at least, we still ended up pretty close to budget. So in other words, it was a really good year for our revenues. Taxes, particularly sales taxes and bed taxes, did really well. Where we really did well is on the expenditure side. We budgeted $105.5 million, and we only spent $102.7. So we ended the year $2.8 million under budget, which is really pretty amazing. That's one of the bigger numbers we've seen in a while. If anybody read the article yesterday in the news press when it talked about sort of a few things, including the results of operations, it reported that we ended the year overspending by $2.8 million. In reality, we underspent by 2.8. I talked to the reporter. They're going to, presumably they made a correction in today's paper, but unfortunately it was reported as being overspent rather than being underspent. So on a budgetary basis, we did really well. We were $2.4 million, $2.5 on a net basis, better than we thought. But for me, the important column is this. This is, the budget is a plan of what we expect to be. The actual is the actual. This is how we ended the year. And we ended the year with revenues exceeding expenditures by $930,000. This will be about the fourth year in a row where during this period of presumably a tough recession, and it was a real tough recession, where we did not use reserves, where we in fact added to reserve balances. So that's great. That just means to, when we think about a contingency reserve that's been underfunded, we are adding to that. However, I will say that as under our new policy requirements, half of that will go toward infrastructure financing. Remember, our policy says 50% of whatever surplus we have is going to be transferred to a capital fund. So we'll be doing that this year. Any questions on this part?
Nope.
Okay, so now we're going on to footnote disclosures, and we always bring to you sort of where we're at with our retirement plans, as well as what we call the OPEBs, which we kind of were talking about earlier. So I wanted to highlight this footnote. It's footnote 9, found on pages 61 to 63, a lot of detail, but this is a summary of kind of the actuarial results of that plan. And so first I want to just mention to you that, and we've told you this before, if you look at the second column, that we're always 3 years behind. So this, for fiscal year 2012, all this information is based on an evaluation that was done as of June 30, 2009. We have new data. We have for 2011 data that we know for next year's PERS rates, but in terms of disclosing fiscal year 2012 data. It's based on 2009 valuation completed by PERS. So let's walk through this. 3 different plans: miscellaneous, safety fire, and safety police. The first number here represents, as we talked about, the accrued liability, or as I always say, how much money should we have in the bank based on the funding plan that's established by PERS. So for miscellaneous, we should have $363 million in the bank. This next number is, and I'm going to tell you that it's supposed to be a measure of what we have in the bank, but it really isn't. You'll see why. But this is what they call the actuarial value of assets. And we'll see that compared to what is the market value of assets, which is the real number. They, as one of the smoothing techniques that they use so they don't see volatility in rates, is to sort of allow the market value to fluctuate but not affect the rates. And so they value our assets a lot higher than what they really are, so that we don't see a dramatic impact on our rates in any given year, and they can smooth that out. But based on the actuarial value of assets, for example, for the miscellaneous plan, we have an unfunded liability of $81.4 million and a funded status of 77.6. A lot better than we've been hearing before, right? We've been talking about in the 60%. And we'll see why in a moment. So there are also disclosures next to that, the annual covered payroll, so $52.8 million. And that then they measured what's the unfunded liability relative to the annual covered payroll. This is supposed to kind of give you an indication of volatility. The higher this number is, the more volatile your rates are going to be, because it's really because of the payroll relative to the overall liability. All this unfunded liability has to be resolved through rates that are impacted on this number here. So the smaller the number, the more volatility you're going to see. So again, higher number, more volatility. For safety, their accrued liability is $131.3 million. On an actual basis, they have 106. So they have an unfunded liability of $25 million, and they are therefore 80.8% funded, and so forth. So I'm going to switch gears now to the same presentation, except I'm going to change that column that says actuarial value of assets to the market value of assets. This is also disclosed in the PERS reports. They tell us what the real market value is, which is very volatile. On that basis, you can see it's a different story. As of 2009, and it's gotten better since then, but on 2009, the funded status for miscellaneous was 56.6, for safety 59, and for police, for fire 59, and for police 57. So a much different story. The unfunded liability is a much larger number, and the volatility index here is a lot higher. So this is what I've been using when I come to council and talk about what our funded status is, which today is about 61%. I've been using this data, but for financial statement purposes, we disclose it in a different manner because that's what the requirements are. So this is what we call the OPEBs, or other post-employment benefits. Those are the 3 things I mentioned. We have a retiree medical and implied subsidy. Retiree medical is that stipend we give to retirees up to the age 65 when Medicare kicks in. We also have the implied subsidy, which is the fact that we allow our retirees to participate in our group insurance plan, which means they pay the same rate as somebody who is a new employee who's 25 years old and otherwise healthy, for example. And so because of that, we're giving them a discount. That's considered a benefit when they retire, and we have to fund that benefit, if you will. So this first row represents the combination of the retiree medical and implied subsidy. Our accrued liability as of July 1, 2011, $34.1 million. About $8 million of that is attributable to the retiree medical number. The rest of it is the implied subsidy. I talked about the fact that we're going to be looking to sort of set up some funding mechanisms so we start putting some money aside for these liabilities. We're not going to be doing that for the implied subsidy number, even though it's a big number. It's really, I don't know how else to say, but it's one of those things that, when we think about retiree medical payments, we pay money out the door. We write a check to our retirees for the retiree medical stipend. When people leave and we have to pay out their sick leave, it's a check we write. But the implied subsidy is really not something that we write a check for. It's just something, the fact that all of our employees in the city, they're paying a little bit higher in their premiums because we have the retirees part of it. But it's not a separate check we're writing. And in fact, the way the GASB rules work and how we measure this, they don't allow us to count the fact that our employees pay a large portion of their premiums. They pay some portion. We don't get to count any of that. So for now, we're going to sort of not try to fund this big number, which is sort of, in my opinion, a make-believe liability. But we are going to look to fund the retired medical payments that we do write a check for, along with the sick leave liability. So about $8 and $4 or $5 million. We're going to look to accumulate over time this $13 million accrued liability, which will grow over time. Any questions on this? I know this is a complicated concept, but this is one of those things that there isn't a lot of discussion on, but it's still a big liability. Some agencies who provide lifetime medical, this number is a lot bigger. It's getting close to what their PERS liability may be, for example. I will say that some agencies have said, we're no longer going to allow our retirees to participate in the same way. We're going to allow them to have a group plan, but they're going to be separately rated. And if that were to occur, this liability would immediately go away. That's the nature of this liability.
May I ask?
Sure.
Thanks. So is this what is referred to sometimes as the annuity, or is that a different payout? It's some benefit that we talk about with the employees.
It is actually. When we've talked about annuities, we've referred to the fact that when folks retire and they have built up sick leave hours, they have an option of getting an annuity for those dollars rather than just getting a lump sum payment. So that we would buy an annuity for them, and that's where this comes into play, for the sick leave hours that they've accumulated. Okay, so along the same line, I mentioned that to the extent that we don't fund these other post-employment benefits, we have to book that liability. You saw that. We don't have to do that today for our retirement liability. We have about a $260 million unfunded liability for PERS. Currently, it's a footnote disclosure. GASB Statement Number 68, which was adopted about a few months ago, and we've talked about this a little bit before, it's going to become effective for us in fiscal year ending 2015. The big change here is that they're going to require us to include within those government-wide financial statements that $267 million within our balance sheet as a long-term liability. And you can just imagine how that's going to change the look of that balance sheet. All of a sudden, our net asset number is going to go down substantially because it's going to be consumed by this huge liability. I don't know what that's going to mean over time. I know a lot of people are going to end up with balance sheets that are upside down. They're going to have a negative number, if you will. I think rating agencies already kind of see this coming, and I don't know if it's going to have a real big impact because it's already known. They're just going to make it a lot more visible to the average reader that, wow, we have this huge liability. I didn't know about it, never read the footnote, and what are we doing about that? So it's just really adding to the visibility of that big number we kind of been talking about. One of the other changes is that with this new requirement, GASB 68, is that they won't be allowing us to use a 7.5% rate of return that PERS assumes. They're saying, you know what, you got to have to use in their opinion, a more realistic rate of return. So it could be down to 5%. Don't know. That's still details that have to be worked out. And they're also going to require that those calculations be made on using amortization periods that are more realistic. A lot of our liabilities are amortized over 30 years. They're saying they need to be more consistent with the actual term of employment of our employees, which is not 30 years. It typically is more like 20 years. So we're going to have to use a shorter amortization period. All that means is that the liability that we measure today will be bigger. It'll be not $260 million, it might be $350 million because of how we're supposed to measure that now. So a big change that's coming due in a few years. So with that, I'm going to have Rich come up, unless there are any questions, and talk about, if you don't mind, Rich.
Any other questions from
I
the
have
committee?
one question.
Mr. White.
I'm thinking that somewhere else, I noticed in this last slide that you're alluding to a 7.5%. When you say discount rate, I presume that's the rate of return
Yes.
on the money.
Yes.
And I thought that somewhere else in the document it was still using the old 7.75. Would that just be a anyway?
Yeah, so
If I find the 7.75, I'll alert you to it. But I thought that was what it was in the.
I think what you're referring to is the fact that for the plans, the evaluations that were completed in 2009, that was before the change occurred, so there was still 7.75. But moving forward, starting this year, they are no longer going to be using that assumption. It's going to be down to 7.5%.
Okay. Thank you. Thank you, Mr. Chair.
Okay?
Please.
So, Rich?
Good afternoon. My name is Rich Kikuchi, and I'm a partner with LSL CPAs, your auditors, and I'm here along with Bob to present to you your audited financial statements. Hopefully you got a chance to look at them a little bit beforehand, and I'm here to also discuss briefly the audit process and putting these all together. LSL's been engaged by the City of Santa Barbara to perform a financial audit of your June 30, 2012 financial statements. You know, there's all kinds of audits that auditors perform out in the world. There's operational type audits where you're actually reviewing the operations of an entity, performance audits, internal audits. There's agreed upon procedures, but we've been engaged to perform a financial audit. And what that really means is the result of that is that we render an opinion on these financial statements as a whole. And to the heart of it, and I'll talk about it in a minute, is that whether we determine that they are materially correct or not. Like Mr. Samario mentioned, these financial statements are put together in accordance with GAAP, Generally Accepted Auditing Principles. There's all kinds of pronouncements that we need to follow when putting these things together. GASB, the Governmental Accounting Standards Board, sets particular pronouncements together, and that's this new pronouncement that Mr. Samario was mentioning as far as pensions go. You know, there's all kinds of ways that we're supposed to report these financial statements, and even as auditors, we have pronouncements that we're supposed to follow, and that's generally accepted auditing standards. So there's certain procedures that we need to follow in order to render an opinion on these financial statements. So in regards to the audit process, well, we spent a lot of time on these financial statements. We probably spent close to 700 hours, myself and my staff, helping to put these together and reviewing these statements. I had about, as I mentioned, about 5 of my people on the team, not only assisting in putting these statements together, but also to test account balances and also to test the system of internal controls here at the City of Santa Barbara. And those internal controls are those policies and procedures that are set in place at the city in order to safeguard the assets of the city, and also to detect and correct any material misstatements in the system. And what I mean by that is, for instance, at the very core, for instance, checks that are written or receipts that are received. We'll go and go through a sample and make sure that, for instance, that receipt that came in is recorded properly and goes all the way up through the system, whether it hits revenue, it hits cash. Checks that are written, we make sure that it's properly authorized and approved. We make sure it hits the right account, it goes right to the right liability account or the right expenditure account. That's why we need to test a system of internal controls, because these financial statements really are based on the city's general ledger. And so, first of all, we need to test the system of internal controls, and then we test those account balances even further to make sure that we're comfortable with those account balances. And so the audit really took place in 2 phases this last year, and it's standard. We usually come out in 2 phases. It's what's called our interim engagement and our year-end engagement. And our interim engagement, we were out here, actually we were here in the month of April, and we were here for about a week, and I had, I think it was 4 or 5 of my staff. I had an audit manager, I had a senior auditor, and I think I had 3 staff here. And pretty much at that time, it was assessing the internal controls of the city. And then we came back out in the month of September, and we were here for, I think it was close to 2 weeks, actually. And at that time, we pretty much spent most of our time doing detailed account analysis, and also we were putting these financial statements together. And that's when it all started. So during the interim engagement, our testing of internal controls really involved looking at your receipting system, your disbursement system, your payroll. We looked at other procedures of internal control. Cash and investments is a big one. And so we made sure that was properly reconciled in accordance with the policy. And so this year was kind of unique. Your redevelopment agency dissolved as of January 31st. And so that was a big headache for the auditors and finance people probably a lot more people in the state of California. But so we did additional test work to make sure that the amounts that were basically dissolved as of January 31st properly transferred over as of February 1. And as Mr. Samario mentioned, that's now reported in a private purpose trust fund. At year end, we came back out, and at that time, like I mentioned, it's a lot of account analysis, and it's all the goal of that audit is really to render an opinion on these financial statements, that they are materially correct, and that's on page 9 and 10. I don't know if you got a chance to look at that. It's a shame it's only 2 pages after all the work we did on this thing, but it's only. But at the heart of what this letter says is that, it says that we follow generally accepted auditing standards. There's prescribed ways and steps that we are required to test the system. We had a long presentation going through it. There's a lot of numbers in there. There's a lot of information, not just only in the financial statements, but also in the footnotes. And then there's the conversion from the fund level statements to the government-wide. And it's a really complex statement. It really is kind of hard to understand. And so what this 2-page document basically says is that myself and my staff, we spend a lot of hours testing the system of internal controls, auditing the account balances, doing enough work that we feel that these statements are materially correct. Materiality is something that's, it's kind of a vague number, but it actually is fairly scientific. We use the prior year's numbers, revenues and expenditures, assets and liabilities, and we put it through this formula that's prescribed by the AICPA, and then it generates a number that, for instance, on the government-wide statements, I don't recall what the number is offhand, but it might be $500,000 actually. And then on the fund level statements, materiality might be as low as $20,000. So when we put all that together and when we're doing our test work, we do it in a way that we feel comfortable that the numbers on here, maybe not every single dollar is exactly where it's supposed to be, but overall, when you put it together, we feel it's materially correct, and we feel comfortable with it, and we're able to render an opinion on that, and that's what this 2-page letter is. And we've issued an unqualified opinion. You will hear auditors say that. It's or a clean opinion. That's the same thing. So that basically is saying, without qualifications, we feel that the information in this CAFR is materially correct, that you can use it to, make decisions upon, that this is a good reflection of what transpired in the prior year. The statement of net assets, the balance sheet is really a snapshot at a particular point in time. At June 30th, 2012, the statement of activities, the operating statements are a summary over the last 12 months. So we're saying, those snapshots, we feel comfortable with that, enough to give you this opinion. And so that's what we've reported to you in that letter. What else? And Mr. Samario mentioned that there's different components of the CAFR, the transmittal letter, the financial section, the management's discussion analysis, the statistical section. Really, as far as the audit process goes, we spend most of our time on the financial section, the notes and the actual statements themselves. But new pronouncements came out last year that we're actually required to do additional test work on the statistical section and on the MD&A when there's references to amounts, and we actually review those to make sure they're consistent with the statement as a whole. So if you had a chance to look at the statements beforehand, I know there's a lot of information in there. The only thing that's really different from the prior years as far as format is the new successor agency. Before, the redevelopment agency was on the fund level, is actually consolidated in the government-wide, but now it's separated out because it needs to be separated out because now it's just winding down. It's an entity that has projects going on, it has liabilities going on, and so a state committee, which actually I'm a part of, decided that it needed to be in a separate private purpose trust fund that's separate from the summary of the city itself, and over time it's gonna go away once all the debts are paid and all the projects are done. And so you might have noticed that. And then also in the footnotes, it was a little bit different because we kind of separated out, and I think that was on note 17, the amounts of the information related to the successor agency. In the past, auditors and we issued a separate component unit level statement just on the redevelopment agency. Moving forward, there won't be a separate financial statement for the successor agency. It'll just be a part of the CAFR. But that information needed to be separated for the bonding agencies and such, primarily, so they could see that information. Two other communication letters that we issued on top of the comprehensive annual financial report. And you probably noticed on the, well, if you got a chance to look at it, on the auditor's opinion, which is my favorite part of the CAFR, that it's addressed to you. It's addressed to the city council. And that's important because auditors really were reporting to you. We're saying, city council, we've done our work, and we feel comfortable with these numbers. That shows on the auditor's report, and we've also issued two other letters to you. The management letter, which is often, it's the internal control letter that's often referred to as a management letter, and then also the auditor's communication letter. In the management letter, we would report to you, and this is also addressed to you, in that letter, if during the course of our audit, we felt that there were particular issues in the internal control, that there was a significant deficiency or material weakness, we would report that to you. And then also in the auditor's communication letter, that's a little more standard, but that talks about, if we had any disagreements with management, if there were any significant accounting policy changes, any other thing that we felt that we needed to communicate to you, that would be in that letter as well. I'm happy to state, as a result of our audit, those two letters were pretty much standard. There's nothing additional that we felt that we needed to report to you. The books and records were very sound, and we didn't see any weaknesses in the internal control. So every year we're going to be issuing, and we have and will be issuing you those three components, the CAFR and those two letters. And so that's kind of the audit in the audit process in a nutshell. I'm glad you invited me here to kind of give you the audit process. If you have any questions, I'm here to answer those.
Any questions for Mr. Kikuchi?
You say
Ms.
your name
Murillo.
Kikuchi?
Yes, very good.
Nice to meet you. So this is an unqualified opinion. So if you had issues with something, it would be a qualified. And then you would say what it was that was
that's
bothering
pretty
you.
extreme. I've been doing this a long time. I've qualified an audit twice over the years. Once there was grant information. A lot of governmental entities get grants from federal granting, federal grant monies, and the system of internal controls is so poor. My staff and I, we weren't able to test it. Even the governmental entity had a hard time knowing what they received and what they spent. And so, since it was a relatively significant part of the operations, I had to qualify that part of the audit. So the opinion said everything, we felt good except for that portion of the entity. And that's a kind of an option for qualifying.
Well, for my sake and for the public who might be listening to, can you tell us why we should trust your company? I mean, I'm being a little simplistic, but,
Right.
LSL has been in the business a long time, and
Yes.
so you have a good reputation.
We do.
We're working against a newspaper article that, that was a whole different thing, but,
Okay.
I think the public needs to hear something positive here.
Okay. Well,
Thanks.
the firm. I didn't get a chance to talk to you about the firm, but I know I don't have too much time, but the firm's been around since 1929, and we actually specialize in the audits of governmental entities. We've been doing it a long time. We actually audit over 60 cities throughout the state of California. One thing is, like I mentioned, we have particular pronouncements that we are required to follow, that we are required to adhere to when we're doing these audits. It's not like I feel like I want to do this or that. It's really, there's certain things that we need to abide by. Also, as auditors, we are required to be audited every 3 years. It's called a peer review, where another firm comes in and actually tests, for instance, how we audited the city of Santa Barbara. Did we do everything that we were supposed to in accordance with the government auditing standards? 3 years ago, 2 years ago when we had our last one, the pronouncements changed just before that. And so they came and basically, tested a lot of our test work. They basically give us a report card. It's basically an audit report. And 2 years ago, the pronouncements changed that even if there was a minor issue where we didn't follow X, Y, or Z, that it would be required to be in the report. I'm happy to announce we got an A+. We didn't even have one item in there that needed to be reported. So I was very proud of that. I was very, very proud of that. And not too many firms get to say that. So I guess that would be my response.
Thank you.
Okay.
Mr. White?
Well, Mr. Chair, isn't there a process whereby the auditors, you have a certain term of years that you audit, and then there's a change? Am I correct in that? Just in order to
Sure.
refresh the process?
Sure. We typically enter into a 3-year contract with CPA firms, and then we evaluate whether we might want to extend it for a couple more years. So we typically will change every 5 years at the least. Recognize that there's a lot of initial costs, and when you train over to new auditors, they have to redocument the new auditors how we do things. Big impact on city staff, because we have to meet with them and interview with them, and we got to go through all the things that we do and describe those things. But once they did it after the first year, then it's just really testing new information. So 3 years is really the minimum I think we'd want to be with it. But 5 years, we might want to change over, but at least 3 to 5 gives us a time to sort of take advantage of all the work that they do up
Sure.
front, so we're not having to change so often. But yeah, changing every 5 years is a good idea, and we typically will do that.
Okay, thank you.
Mr. Kikuchi, I don't want to keep us here too long, but I did have one question. When you talked about testing the internal controls, for
Yes.
instance, making sure that revenue comes in some form or other and goes through the chain in the right way, could you give an example of how exactly that testing happens?
Yes, it begins with inquiry. Well, like one of my staff will maybe go to a clerk to see, whatever revenue type it is, how do you process this, and go and basically document the entire process on how that person processes it, and we'll actually go to, for instance, the terminal to see exactly what keys they hit and what accounts they hit. And so they'll actually go through that process, and then we'll independently, depending on the discussion and the results of our assessment of internal controls as a whole, we might do sampling on that and actually pull particular receipts from actually from the document itself and trace that it was properly approved, that the amount that was recorded into the system matched that source document, and trace that not only how it was posted, but actually how it was summarized in the account on the general ledger. So we'll actually go to the very source document.
Okay. Thank you very much.
Thank you.
No further questions? Meeting adjourned? Oh, I'm sorry, Mr.
just
Smart, do
wanted
we
to-
have to
Well, and I
make a recommendation?
Did you?
Well, I appreciate we're running out of time, so I won't go into the further detail, or I'll ask you privately. But I did see on page 63, I heard you mention, Mr. Samario, that there's a $250, I thought you said $7 million unfunded liability in pensions. And I'm looking at that page and seeing what I'm imagining to be a different number. So I just thought you could share where you developed the 250 as opposed to the 160 or whatever.
So
would come out of adding those three up.
Sure. So if you're looking on page 63, the first, second, third, fourth, the fifth column over, which is labeled unfunded liability.
Right.
Or excess assets, in our case, we have an unfunded liability. If you were to add up those three numbers,
Right.
that represents the unfunded liability. And except that in this report, it's using an actual value of assets versus the true market value. So under this case, the unfunded liability is probably somewhere in the $170 million range.
Right.
You just add those three numbers up.
Right.
But on a market value basis, which is, I think, more appropriate, a more accurate measure of what our status is, it's in the area of $260 million. And if so, if you go, let me just
Can you
go
describe the difference
right here.
between those two?
So if we, this is exactly what's in the footnote disclosure on page 63. So again, it uses this inflated number, which is the actuarial value of assets, which we know is not real. It's just for smoothing purposes. It's used as a way to smooth rates over time, so we're not seeing big hits to our rates when there are significant asset losses in a given year or period of time. So, but this is what we disclose in the footnote, and that has a direct then bearing on what our unfunded liability is, because this number is fixed. This is the true amount of money we should have in the bank. This is a measure of what we actually have on an actual basis, and therefore the difference is the unfunded liability. If you add these three numbers together, you get about $140 million, right? But if you go to this number, or this presentation, which is not in this CAFR, but I just wanted to show you this because this is how when I talk about what our funded status is, I use the market value of assets. And this number is significantly less than the previous page. See that?
Yeah.
So therefore, the unfunded liability on a market value basis is significantly higher. So 157 plus 53 is 210 plus 74 is 285. That was as of 2009. It's gotten better. Actually went down to 260 as of 2010's, based on 2010's valuation. It's going to go down a little bit in 2011, but then back up in 2012. It rides sort of the true, asset values. So that's where you see the difference between the 260 that I talk about. It's really based on a market value of assets versus what they disclose and report as the actuarial value of assets.
And that chart is where in here?
That's you were just looking at that, at the very top. So this
No,
chart
I'm just
here.
not seeing the two.
This chart is not
Correct.
in the CAFR.
Yeah,
This one is not in this document.
So the first one I showed you, which is using actuarial value of assets,
Right, that's
it's right,
here.
that's there.
Right.
This one is not, because I just changed the first blue column to report the market value of assets, and that does come from the PERS valuation reports. I mean, that's not a made-up number. It's just not part of the required disclosure in the CAFR.
Okay. I know we're running out of time.
Okay, so we're going to make a similar but more brief report to council. There'll be a lot of the same information. I apologize, but I think it's important information for council to hear. It'll be maybe 20 minutes long at council, but anyway, just wanted to have you,
Okay.
At least make a recommendation to forward this to council and have their approval.
Do we need to make a recommendation here?
Sure.
Okay.
And I would so move.
Second.
Any further discussion? All those in favor?
I
Aye.
Thank you all.